There's a way that you can put money into the Roth IRA and still get a tax deduction in the year of your contribution. And I'm going to show you the strategy. This is going to work well for a small business owner or somebody who gets large bonuses, or if your income is just fluctuating and you have a spike in your income and you're trying to reduce your taxes, but at the end of the day, you're trying to get more money in the Roth IRA. And I don't blame you for wanting to get all your money in the Roth IRA, but the name of the game here is to smooth out your taxes today and tomorrow to get into the lowest tax bracket possible. And that is gonna help you put the most money in your pocket and obviously save the least or save the most amount in taxes. So here's how this works. So let's start from the basics. The Roth IRA, we know we put it in, it goes in after tax, we get no tax benefit from making the contribution into the Roth IRA, but it's gonna grow tax deferred, and as long as we take it out in retirement, that growth is gonna come out tax free for the most part. You could take it out for some other things. On the other side, we have the traditional side, and that goes in pre-tax, which is a great benefit in the year of the contribution. However, it's gonna grow tax deferred, but when we take that out, it's gonna come out as ordinary income. Generally, that's how these two types of accounts work. Now, there's a little bit of a strategy, and like I said in the beginning of the video, that you can get a tax deduction and still end up with Roth IRA money. So I'm gonna draw it out to show you how this works and talk a little bit more about why this will benefit you. So here we have the traditional IRA and the Roth IRA. Like I said, we make a contribution into the Roth IRA. There's no benefit in that year, but we get that benefit because we're not gonna be paying taxes on the growth. And with the traditional IRA, we put it in, we get our income tax deduction. Now, the year that you make the contribution into the traditional IRA is the year that you're going to benefit from it. So what we'll do here is we'll make a $6,000 contribution into the traditional IRA this year to get that tax deduction. And then once we get into the following year, so right now we're in 2022, we get into 2023, we do a Roth conversion. So we could take this 6,000 and then convert it over to the Roth IRA. Now it's going to be taxable in 2023. So we're making that contribution, getting the tax deduction this year, and moving that income, effectively moving the income from this year to next year. And in doing so, you're smoothing out your taxes. And like I said in the beginning of the video, this is for the small business owner who might have had a spike in your income or you got a big bonus and you're saying, well, how can I just reduce my taxes? Why would you want to do this strategy as well, besides just tax brackets? You also want to look at other deductions or credits that you might not have otherwise qualified for, or to qualify for more. For example, the child tax credit, the saver's credit, any of these credits have income thresholds. And if we can get right below those thresholds, we would then qualify for them. So take a little bit closer look as you're getting close to the end of the year at your taxable situation to figure out if this makes more sense. Now, if you've already contributed to the Roth IRA, what you can do is you can recharacterize it over to the traditional IRA, and then you can just go right back. And I know it's a little bit more work and not something that's ideal. So in this type of a situation, if you're a small business owner, somebody who gets a bonus, have a spike in your income, then you might want to just wait until the end of the year. Now you do have until your April filing deadline to make the contribution, but in this scenario, you're gonna wanna do this before 12/31 so you can get that income tax deduction and then do the conversion. Why is that? Because while you can get the pre-tax amount into the traditional IRA up until your April filing deadline, the Roth conversion is taxed at the time that you do it. So that's when it's taxed. So that's why we would want to make the contribution into the traditional before 12/31 and then do the Roth conversion over to the Roth IRA. And then you have your pre-tax money, and then you're ending up with tax-free money in your Roth IRA. So hopefully this has helped. Take a little bit closer look at your retirement plans to see what makes the most sense. If you have questions on it, let me know in the comments down below. And if you've enjoyed this video, be sure to subscribe, and we'll see you on the next one.